Hello everyone, this is BHAVIK CHOKSHI here and I hope you guys are doing great. In today's video, we will be doing a quick revision for the concepts and all the key adjustments for consolidation in case of a subsidiary. The legal guidance over here is given under IND 110 and the accounting framework has been given by Companies Act section 129, which requires that a company which is a subsidiary, also a joint venture or an associate, if applicable, will have to prepare consolidated financial statements in addition to the standalone financial statements. What is a CFS? Well, CFS is joining the parent and the subsidiary, considering them to be one. So Reliance Industries Limited is a separate legal entity and Reliance Jio Limited is a separate legal entity. However, if they were to be treated as one and the same, lifting the corporate wheel, if they were to be treated as one, what will be the overall position? That is the CFS of Reliance Industries Limited. Is it mandatory? Well, yes. What are the methods to be followed? Well, there are three group entities that we kind of count. The subsidiaries, where IND 110 applies and we follow the full consolidation method. The joint ventures or associates, where a equity method typically applies, which we will do probably later. Today's session we will focus on the full consolidation method. So how do you do a full consolidation? Well, when does consolidation apply? Consolidation applies when you acquire control over a business. Control usually comes from the ability to direct relevant activities, among other things, which is at a greater than 50% stake. So the moment you have control over an entity, you are supposed to consolidate that entity even though it has a separate legal existence. Till when will consolidation continue? Well, till the time the control exists. The moment you give up control, or there's a stake sale which happens where you lose control, well, consolidation kind of ends, and as a result you will consolidate an entity till the time you have control. Now, a lot of times students over here get confused on when should we apply IND 103 business combination and when should we apply IND 110 consolidation. The general rule over here is on the date of acquisition, if you are preparing the balance sheet, the principles of IND 103 business combination are applicable. Business combination guides you in preparing that opening balance sheet, and after that every subsequent balance sheet that you prepare, considering the opening balance sheet which has been prepared, will be as per IND 110. So IND 110 kind of guides you on what do you need to do for post-acquisition profits, what do you need to do, how do you calculate minorities or non-controlling interest, what will happen if additional stake is acquired, etc., etc. Now, what are the essential ingredients of a full consolidation method? First, the essential ingredient is that you will consolidate 100% of the assets or liabilities irrespective of the actual stake that you have. So you might be owning, let us say, an 80% stake in a company which gives you control. However, you will consolidate 100% of the assets, 100% of the liabilities. Now, why would you do that? Well, the reason is because you have the ability to direct what is to be done with the entire asset. So, for example, if I am Reliance Industries Limited and if I have a subsidiary Reliance Jio in which I have, let us say, a 70% stake, in which case, let us say if Jio has a land parcel of 100 acres, Reliance Industries, by virtue of its 70% stake, can direct what is to be done with the 100 acres. Should you construct a head office? Should you sell that off? Should you kind of construct a telecom or tower network? What you want to do is going to be directed by Reliance Industries, not just for 70%, that is 70 acres, but for the entire 100 acres. And hence, even if I have only a 70% stake, I will still consolidate 100% of the assets, because I want to tell the readers on what is the assets which I have the ability to manage, control. However, that may not necessarily result in a right presentation, because I am showing I am having a 70% stake, but I am showing the entire 100 acres of land in my books. 30 acres, or not 30 acres really, but 30% of that land, if it is sold, is actually attributable to someone else. It is not attributable to me as a controlling shareholder, let us say Reliance Industries Limited. However, it is attributable to someone else. That someone else is also an owner, is also a shareholder. These are the other shareholders in Reliance Jio Limited. There are around 11 or 12 other shareholders in Jio. If that land is sold, money is received by Jio, 30% of that money is going to go to the other shareholder, 70% is going to come to the parent, that is Reliance. And as a result, we create what you call as a non-controlling interest under AS, which was called as minorities interest. Non-controlling interest is typically calculated by calculating a percentage share of the net assets, proportionate net assets. So if Reliance Jio has a net asset base of 1000 crores, 70% of that is attributable to parent, but 30% of that is attributable to non-controlling interest, and hence 1000 into 30%, let us say 300, would be the value at which non-controlling interest is recorded. Now, what is the reason for the birth of NCI? NCI is born because parent, which has a 70% stake, is consolidating 100% of the assets, and hence out of that 100%, we are saying 30% is attributable to someone else, which by the way is called as NCI. Now, NCI will continue to appear. The question is, where will it appear? Well, it will usually appear as a part of equity because they are also owners. Under AS, used to show it between shareholders' funds and liabilities. Ind AS says no, this meets the definition of equity. They are having residual interest and hence they are also equity. This is important because going forward you will study that can the non-controlling interest ultimately be negative? We will say yes, because owner's equity can very well be negative. P&L can have a debit balance. In a similar way, NCI, which is also owners, can have a debit balance, and as a result NCI can be negative because it is classified as equity, which was not the case in AS. Now, how will you proceed with the consolidation? We are going with the core consolidation principles. Usually when you see the exam questions, you would be given the separate financial statements or SFS of the parent, and then a separate financial statements, that is SFS of the subsidiary, maybe 2 or 3 years or 1 year after the date of acquisition. So I will have the SFS of parent and I will also have the SFS of the subsidiary. So ideally I should join all the assets and all the liabilities of the parent and the subsidiary, yes. However, there might be some intercompany items, like in the parent's books, separate financial statements or SFS, there would be an investment in subsidiary. Now, this investment in subsidiary will typically be appearing at cost because there's a standard called as IND 27, separate financial statements, which gives a choice that the investments in the separate SFS can either be shown at cost or following 109. Throughout your syllabus, usually the institute always assumes that they are shown at cost, which is also the case practically. So your investments will typically be at cost, which is like the purchase consideration that you must have paid when you acquire the controlling stake. So can this investment continue to appear? Well, it appeared in the SFS because subsidiary was a separate legal entity, but now when you are preparing the CFS, subsidiary is no longer a separate legal entity, and hence you should eliminate the investment. That investment cannot appear because instead of the investment, you are taking over assets and liabilities. Will the assets and liabilities appear of the subsidiary? Yes. Can the investment appear? No. But then that investment represents what? Well, that investment of 70% represents the 70% share that Reliance Industries has in the share capital of Reliance Jio and also in the reserves of Reliance Jio. And as a result, this investment will be eliminated against the share capital and the pre-acquisition reserves to the extent of your share. Okay. So this is the consolidation principle. You will consolidate assets and liabilities, eliminate the investment against the parent's share in the share capital as well as reserves of the subsidiary. Now, what will happen? What will you do with the reserves of the subsidiary? Let us say hypothetically, let us hypothetically that transaction did not go through, but just for an understanding, assuming it went through, Reliance Industries acquired Future Retail. So if Reliance acquires Future Retail, in which case, as on the date of acquisition of Future Retail, there might be certain reserves that Future Retail has. These reserves were actually earned by the shareholders of Future Retail, like Mr. Kishore Biyani and other shareholders. However, when Reliance acquires a stake, they will pay a premium because they are getting a company which has shares and along with that a lot of reserves. So typically pre-acquisition reserves are actually acquired by Reliance because after acquisition, if they were to distribute, then these are reserves for a period when they were not the shareholders. So you will have to pay a PC for that. However, the reserves that Reliance earns post the acquisition of Future Retail are called as post-acquisition reserves. These are reserves earned which are because of the efforts, management and time spent by Reliance Industries in Future Retail. These are called as post-acquisition reserves. What do you do with post-acquisition reserves? Do you also eliminate it? The answer is no. Post-acquisition reserves belong to you as a parent because they have been earned during the period when you had control, and hence the law allows you, IND 110 allows you to consolidate the post-acquisition reserves to the extent of your share. However, pre-acquisition reserves need to be eliminated because they were earned No. Were they actually purchased? Yes, you paid PC. A company which has a higher net worth as on the acquisition date, you will have to pay more PC. If the company has a lower net worth, you will pay lesser PC, and hence these reserves were actually acquired. And hence pre-acquisition reserves attributable to the parent are not usually consolidated. Post-acquisition reserves are usually consolidated. Okay. Will NCI change? And before that, if my investment, for example, is 1,000 rupees, let us say Reliance invests and takes a 70% stake in Reliance Jio Limited by paying, or Reliance Future Retail, let us say, by paying 1,000 rupees. Now, if I look at Future Retail Limited, FRL, its equity share capital is, let us say, 500. Let us say its P&L as on the date of acquisition or retained earnings is, let us say, another, let us say 600, and let us say the net assets that Future Retail has is worth 1100. Now, in order to get a 70% stake in this, Reliance has actually paid 1,000 rupees. Now, there are two ways in which you can calculate goodwill. We can say PC, that is purchase consideration, is 1,000 for a 70% stake plus non-controlling interest, which can be measured typically using the proportionate net assets method. There is also another method which is possible, which is called as the fair value method, which you might have done in business combination. But let us say for the time being, NCI using proportionate net assets method would be, well, there are 1100 worth of net assets, 30% of them are attributable to the NCI, and as a result, this is 330, and net assets, 100% of the net assets, which is worth 1100, and hence the goodwill, which is called as the partial goodwill over here, would be probably 230 rupees. So this is what you do typically in business combination. In consolidation, what happens is you will consolidate this 1100, and that is provided the balance sheet as on the date of acquisition is given. However, in all likelihood, you will be given a balance sheet 2 or 3 years later. So probably instead of giving this balance sheet to you in the exam, what you will be given is the balance sheet of Future Retail Limited plus 2 years. It's a balance sheet 2 years after the date of acquisition, in which case probably during those 2 years you have earned profits worth 200 rupees, and hence your P&L has become 600, which is there as on the date of acquisition, will be given in one of the adjustments, plus 200 which is earned during the 2-year time frame, in which case you will have a P&L of 800 and the net assets given to you as 1300. But these are net assets not as on the date of acquisition. This is as on the date of consolidation. So will you consolidate these net assets worth 1300? The answer is yes. However, these net assets worth 1300 were not existing as on the date of acquisition. So if you want to calculate goodwill, you need to find the net assets as on the date of acquisition, which you probably don't have in the type of question that is given in the exam. So what do you do? Well, we remember that the net assets can also be calculated in the form of net worth. Net asset is calculated as asset minus liability. Net worth is calculated as share capital plus reserves, other equity. So we try to say that, okay, if I can't find the net assets, I will try to take a proxy that is net worth. But the net worth also over here, that is 500 plus 800 is a net worth as on the date of consolidation, that is 2 years later. But if I want to find a net worth as on the date of acquisition, can I somehow back calculate it? Well, the answer is yes. I can say that, okay, unless given otherwise, the shares remain the same. Typically, we buy shares from the selling shareholders. The company does not issue fresh shares. And there are 600 rupees which are there in the pre-acquisition reserves. So 800 is the reserves today, out of which 200 is earned after the date of acquisition, which means 500 or 600 must be there as on the date of acquisition, which will be given to you in the adjustments. And hence we can back calculate and say, acha, 500 and 600, that is equal to 1100 is actually the net worth, which is equal to the net assets. And hence if the net worth is 1100, how will you calculate goodwill? Now, there are various ways in which you can do that. You can either prepare a statement like this when you have done what you have done in business combination, which will give you 230, or you can prepare a ledger account called as cost of control, which will also give you 230, or you can prepare a statement. Whatever method you do, it will work as long as you're getting the same answer. So, for example, if we prepare a statement, I can also prepare a ledger, but that will just be various different ways of presenting the same solution. I will say, how will things proceed? Well, we will say that if I do the goodwill working, PC is equal to the amount of investment. So your purchase consideration, for example, is 1000, which is appearing from the separate financial statements of Reliance Industries Limited. We are trying to compare our share in the net worth. Our share in the net worth. So if we try to find our share in the net worth, which is 70%, there are various ways in which you do it. In fact, different professors have different way of solving. As long as you are getting the same answer, it does not matter. Please don't think that this is a presentation, that is a presentation. 5 different sums of the institute also will have 5 different presentations. As long as you are getting the same answer, preparing the consolidated balance sheet, showing the goodwill, it will not matter. So over here, this is pre-profit and loss and equity share capital. We cannot consolidate the equity share capital because share capital will be the share capital of the parent. Subsidiary share capital is attributable to the parent to the extent of 70%, remaining 30% is attributable to NCI. So we will say today I can see 500 ka 70%. So this is 500 into 70%, that comes to, let us say, 350 is attributable to your share in the net worth, which was there as on the date of acquisition. Pre-P&L, okay, today the P&L is probably 800, but as on the date of acquisition, your P&L was 600 into 70%. If I calculate, 600 into 70% will come to probably 420. And as a result, 350 and 420 will come to, I think, 770. If I take the difference, you are comparing 70% with 770, your share of the net assets, you will still get a goodwill of 230. I'm just doing this in rough for an understanding. You can also compare and calculate NCI at 30% and then compare it with 100% of the assets. Your answer will be the same. The essence that we want to draw out of this discussion is you will eliminate the investment against your share, parent's share in the pre-acquisition reserves and share capital in order to find the goodwill as on the date of acquisition. This goodwill will not change, and currently this goodwill is calculated assuming this is partial goodwill method, NCI using proportionate net assets. This goodwill can also be calculated using the full goodwill method, in which case NCI will have to be calculated using the fair value, and then you will have to take the investment, that is for 70% plus the fair value of the non-controlling interest minus 100% of the net assets or net worth as on the date of acquisition. That will give you the full goodwill. Now, what about the 200 which was earned after the date of acquisition? What about it? Well, we will say that when we look at non-controlling interest, NCI, the non-controlling interest does not care whether profits are earned prior to the date of acquisition or post the date of acquisition. A non-controlling interest says that, well, equity share capital is 500, out of which 30% belongs to me, and as a result 500 into 30%, that comes to 150. Again, pre-acquisition reserves, which are 600, 30% belong to me, which is, let us say, 180. And post acquisition as well, you have earned 200 ka 30%, that is equal to 60, which belongs to me, and hence this total will come to 150, 180 and 60. So this is, I think, 240 and 150. This is probably 390, which makes sense. It is 1300 today into 30% will come to 390. But what about the remaining 70%? Over here, 200 ka 30% is attributable to the NCI, but the remaining 70% is attributable to the parent, and the parent's profit is appearing in the consolidated other equity. 70% of 200, that is 140, was earned under your regime, under your control, will be allowed to be consolidated. And the consolidation principles tell you that your share in the post-acquisition profits will be consolidated. That is, they will appear as a part of your consolidated retained earnings or reserves. So you will start with the standalone reserves of the parent. To that you will add the share in the post-acquisition reserves of the subsidiary. Now there's a lot of theory that we have taken as a conceptual base. Again, this is kind of a revision lecture, so I can't really go into a lot of numbers and spend a lot of hours, but I'll just try my best to kind of give you an overview of both the concepts as well as the steps. So this takes care of the conceptual framework of consolidation. Now the most important thing is the steps that you need to follow in the consolidation process, and third, the key adjustments that are there. So what are the steps? Now these are the steps that I prefer. You might have studied probably from a different faculty who might have a different step, and that is absolutely fine. As long as you are comfortable with the process, you can follow any steps as long as you get the same outcome. So this is something that I prefer doing. Again, you can have an alternative version, that's absolutely fine. So what are the steps in consolidation process? Step number 1, you will prepare the format of the Schedule 3 balance sheet. When you prepare the format of the Schedule 3 balance sheet, you will have the name of the company at the top. Let us say RIL Limited and its subsidiaries. You will not write and its associates and its joint ventures. No. RIL Limited and its subsidiaries. The next thing that you write is consolidated. The word consolidated has to be written. Consolidated balance sheet as that. You will give a particular date and then you will chalk out the Schedule 3 balance sheet. So do we need to write every line item of the Schedule 3 balance sheet? No. Only those items which are relevant in the question need to be written, but they need to be written in the Schedule 3 format. That is, you start with assets, then non-current, then current. While doing non-current, write a separate line item for goodwill. Then you go to equity and liabilities. Within that equity, within which you will have other equity as well as non-controlling interest, and then non-current and current liabilities, like you must have done in Schedule 3. So that is the first step. You prepare the Schedule 3 balance sheet typically as a format. There will be 3 exceptions where you might need to do some workings before you prepare Schedule 3 balance sheet. That is, a few adjustments. We'll study 12 adjustments, out of which around 4 or 5 are important. More important. Every adjustment is important. But there are 3 specific cases where before you prepare the Schedule 3 format and proceed further, you will have to prepare a working note. First, if the subsidiary has different accounting policies as compared to the parent, before you start consolidation, you will have to restate the subsidiary's balance sheet as per the parent's accounting policies. You will prepare a working note, prepare the subsidiary's restated financials, and then consolidate. Second, if the subsidiary has a different reporting date as compared to the parent, that is, parent is consolidating 31st March, subsidiary is consolidating subsidiary is preparing 31st December, then you will have to prepare the subsidiary's restated financials as on 31st March and then proceed with the consolidation. Third, if there's a foreign subsidiary, it would have prepared its financials in a foreign currency. You will first have to translate it into the parent's functional currency using the appropriate rates as suggested by IND 21, and then you prepare the Schedule 3 format. In all other cases, you can directly start with the Schedule 3 format. Next, what do? Well, you prepare notes. When you prepare notes, you will write the name of the line item, like a property, plant and equipment. Then whatever property, plant, equipment appears in the parent's balance sheet, Reliance balance sheet, you will write that. Whatever plant and equipment appears in the subsidiary balance sheet, you will write that. There are 3 subsidiaries, write 3 different line items. So there will be parent, there will be subsidiary 1, subsidiary 2, subsidiary 3, and then there will be a column on adjustments. This is a format we usually do. Though if you see, this is a format which is done even in the business combination chapter, but in consolidation as well as in certain suggested answers, Institute uses a separate note for every line item, like property, plant and equipment, then parent, then subsidiary, within that adjustments, then let us say inventories, parent, subsidiary adjustment. You can follow that as well, just that it is a little more time consuming. Either should work, but in the interest of time, a tabular format may be a little more faster. If you don't have even that much time in the exam, as a last resort, then in the Schedule 3 itself, you can write inventories into bracket, you will show the numbers. Probably a couple of marks might be deducted, but if that helps you in saving 5 minutes, well, you can do wonders in the last 5 minutes. You do get superpowers and you can finish up a lot of stuff. So if that be, then you can just write down in brackets, sacrifice 2 marks for a larger 8 or 9 mark question. Take. So over here, these are the notes that you will prepare. You will write down each and every line item of asset, each and every line item of liabilities. You will note down all the assets. You will note down all the liabilities as they appear in the balance sheet, except for 5 items: share capital of parent and subsidiary, then reserves of parent and subsidiary, and investments. So these are the 5 items which will not be there. Investment in subsidiary, these are the 5 items which will be pending. Now, what should you do next? Well, you will also prepare a statement for equity, like you will show equity share capital, where you will take the parent's equity. Remember, parent and subsidiary equity is not consolidated. In fact, equity of the subsidiary is eliminated or attributable to NCI. So you'll prepare a note where you show the equity of the parent. Acha. Next, you will prepare 3 working notes. Typically, every working note should take around 8 to 10 lines in the exam. Working note number 1, consolidated other equity. Working note number 2, cost of control or the goodwill statement. Working note number 3, the minorities interest or non-controlling interest, as the case may be. How do you start these working notes? Working note on other equity. You will, if you have multiple reserves, you will take the reserves in a columnar form, like a general reserve, like a retained earnings, like other reserves. and then start with standalone parent. So you will write down the balance which is there in the standalone parent, maybe something like this. You will write down standalone parent from P's balance sheet. So there were 5 items, out of which you have written the share capital of the parent in the note on equity share capital. You have written the reserves of the parent in working note number 1. Then you leave around 8 to 10 lines and go to working note number 2, which is the goodwill calculation or the cost of control, in which case you start with the investment, because PC, purchase consideration that you paid, is investment from the parent's balance sheet. So investment is taken over here. But investment compare kiske saath kare? Well, your share in the net worth if you are following the partial goodwill method. Alternative formats can also work. Your share in the net worth. Okay. Investment is done by the parent only in the subsidiary, so non-controlling interest does not have any share. However, this investment needs to be compared with share capital and pre-acquisition reserves. Share capital of the subsidiary, 70% of that is attributable to the parent. So you will write that along with let us say the purchase consideration or investment. You can even show this in a ledger format or in a statement format. But the remaining 30% is attributable to non-controlling interest, and unless otherwise given, we assume that the non-controlling interest is calculated using the proportionate net assets method. It can also be calculated using the fair value method, for which slight modifications will have to be done in the steps, but first we focus on the partial method. So with that, you have considered all assets and all liabilities in a systematic manner, all assets and all liabilities appearing in the parent's balance sheet, all assets, all liabilities appearing in the subsidiary's balance sheet, the share capital of the parent, the share capital of the subsidiary, the reserves of the parent, and the investment in subsidiary, and only one item remains, that is the reserves of the subsidiary, which you need to analyze. You can't blindly consolidate like you consolidate assets. You can't blindly eliminate like you eliminate share capital of the subsidiary. You need to analyze, because pre-acquisition reserves will be eliminated, but post-acquisition reserves will be consolidated. Again, they will be eliminated / consolidated in the ratio of parent and NCI, and hence a separate working is required. This is a stage where you need practice. So by the time you read the question and reach up to this stage, around 8 to 10, I mean probably including the reading time and probably the format and presentation, I would want you to reach this stage at the 10th minute max. Remember, this is going to be a 16-mark question. The thumb rule is 100 marks are 180 minutes, so 1.8 minutes. So if you have 16 marks, typically it will take 28, 29, let us say 30 minutes approximately. Consolidation rarely gets over in 30 minutes, and hence you have to optimize time. At best 35 minutes में आपका होना ही चाहिए with good practice. Consolidation is process driven, less concepts, more of process. So at this stage, अपने systematically schedule 3 format बनाया, notes, you noted down all assets, all liabilities, share capital. Then you have 3 working notes, 1, 2 and 3, roughly one third of a page, and you will write down, start with standalone parent, then in the goodwill working, start with investments, adjust the share in share capital, give a part of this to the non-controlling interest, and then you go to the most important step where you have to rack your brains for consolidation, consolidated other equity. So when we're looking at consolidated other equity, we need to analyze the reserves of the subsidiary. How do we do that? Well, we typically start by preparing, again you can do it in a chart or a diagram format, or you can prepare it in a tabular format. Don't focus too much on the format, focus on getting the numbers in that format, whatever you're using, right? So different authors, different professors, institute के material के अंदर different sums can have a different format. You can't tweak around with the schedule 3 format, but working notes are your luxury, your liberty. As long as you're getting the same answers, it will not matter. So when we look at analysis of retained earnings or analysis of all the reserves that is there in the subsidiary, you will take one reserve at a time. Typically, retained earnings is considered to be the last reserve that you should take in the order of preference, but first you take all the reserves available like general reserve, other reserves. Usually the balance as on the date of acquisition will be given, that means the remaining will be post acquisition. So if the balance today in today's balance sheet is 800 and as on the date of acquisition you had 600, that means the remaining 200 is post acquisition. What will you do with the pre-acquisition reserves? Well, to the extent of parent's share, the balance in the pre-acquisition reserves will go to the parent. To the extent of NCI share, it will go to the non-controlling interest. Same is the case with the post-acquisition reserve. Now, how do you actually work around this? Well, the best way to do this, in my opinion, would be to have 4 columns where you start with the particulars, then you have the total numbers, then how much of that is pre, how much of that is post. You can do it in a tabular format or in a chart format. You start with the balance as on the date of acquisition if it is given, or the balance at the start of the year, whatever is given. Sometimes your date of acquisition is 1st October 2022 and the balance is given, opening balance is given on 1st April 22. So you start with the balance which is given, the earliest balance which is given. Then you try to find a statement where you reconcile. So if the earliest balance on 1st April 22 is given and today you are preparing the 31st March 23 balance sheet, in which case you try to find that why should the balance at 22 not be the same as balance at 23? Well, it may be because of profits earned during the year 22-23. It may be due to dividends paid during the year 22-23 or any other reason. So we will take the balance. To that you will add the profits during the year less dividend if any, and that will give you the balance at the end of the year. Now you will analyze each of these items. So typically the balance at the start of the year is pre, it is prior to acquisition. So we will put that in the pre column. The profits during the year you will have to see, or profits during the period, you will have to see if the date of acquisition is 1st April 22, then the entire profits are post acquisition. But if the date of acquisition is 1st October 22, then you will have to segregate them, 6 months pre, 6 months post. Dividend, well, depends on the profits from which dividend is given. So if dividend is given out of opening balance, it should be subtracted from pre-acquisition profits. If it is given from the current year's or the post-acquisition profits, it will be subtracted from the post, and that will give you the split of the balance as appearing in the balance sheet. However, there might be certain consolidation adjustments which you need to adjust here, like the fair value adjustments, like upstream/downstream if applicable, or various adjustments. So what you will do is you will try to split the balance and then give effect to the adjustments. This is the heart of the question on how will you adjust fair value adjustments, how will you adjust dividend adjustments or upstream/downstream adjustments. After that you find an adjusted balance, and that adjusted balance is attributable to owners. But owners are not just Reliance Industries, it is Reliance Industries as well as the non-controlling interest. So the pre-acquisition reserves, what you have found as the adjusted balance, will be attributable 70% to the parent, but this is a part of pre-acquisition reserves, and hence this will go in working note 2, that is a goodwill working. You will say that as on the date of acquisition, this is the balance which was attributable to the controlling shareholder, should go for goodwill workings. Non-controlling interest, over here they will also have a share. So this will go in working note 3, which is on non-controlling interest. Now post-acquisition profits, over here you will again segregate, like in our example 600 was pre, 200 was post. 600 would be segregated 70% to the parent, 30% to NCI. Similarly 200, which is post, will be segregated 70% to the parent, that is 140, and 60 to NCI. The 140 will be adjusted or added with working note number 1, that is your share in the post-acquisition profits of the subsidiary will be added in your consolidated other equity working note, and the remaining will be attributable to, let us say, the subsidiary NCI. So that will be going into the NCI. So NCI does not honestly bother whether it is pre-acquisition profit and loss or post-acquisition profit and loss. Both of them are attributable to the NCI only. And this is how you will give effect to all the 4 items. Once you have given effect to all the 4 items, implicitly you have given effect to all the adjustments as well as the balance appearing in the balance sheet, and as a result, you have given effect to everything. This was the only item which was remaining, the reserves of the subsidiary along with the adjustments given. So what we typically suggest is you prepare the analysis of reserves. You try to have the balance given at the start plus the profits less the dividend gives the balance. Leave around 8 to 10 lines to show the adjustments and the split, and then prepare another working note, that is working note 5, where you can do the fair value adjustments or the upstream downstream adjustments or the dividend adjustments that may be there in the question. Typically in the question there might be 2 or 3 adjustments, and or there might be a chain holding type of a question. We will study that. So this is the standard format that we should ideally follow. At this stage everything else has to be buttoned up and closed. Like if there are any other adjustments like intercompany, debtors, creditors, or bills payable, bills receivable, all of these adjustments have to be given in the respective items, and after that all your assets and liabilities should be ticked off, all your adjustments should be ticked off, and you should be in a position to now total up. You will now try to total up in the sequence. First the goodwill, see if there is goodwill or capital reserve, then the consolidated reserves, then the NCI. You can also switch around with the sequence. The goodwill over here will be added into the balance sheet. NCI will also go directly into the balance sheet, and the consolidated other equity reserves will also go to the balance sheet. After that is done, you will total up the assets and liabilities like you have prepared over here. After the adjustments, total up the assets and liabilities, post those numbers in the balance sheet, and you are good to go. 16 marks in your pocket. So what are the two important things in consolidation? The process. Step number 1, Schedule 3 format. Step number 2, assets and liabilities note. Step number 3, the 3 crucial working notes with postings for standalone P&L, with postings for investment, with postings for your share and the NCI share in equity share capital. Step number 4, you analyze the reserves where you split the profits between pre and post, give effect to the adjustments, and then at the end attribute the profits to the parent and the NCI. Parent share in the pre-acquisition profits goes to goodwill working note 2. Parent share in the post-acquisition profits goes to the consolidated other equity working note 1, and NCI share whether pre or post will go to working note 3, which is NCI, considering proportionate net assets method. Now, what are the crucial adjustments over here? Now, this is the format, okay? You will total up and pray to God that your consolidated balance sheet does tally. Now, what are the adjustments over here? The consolidation adjustments. There are around 12 or 13 of them, out of which the important adjustments in my opinion are in the order of importance. The fair value adjustment being the most important, second being the upstream or downstream inventory adjustment, third being the dividend, especially the pre-acquisition dividend adjustment, and then a separate category of sums where you have chain holding. So the chain holding adjustment. These, in my opinion, are the 4 most important adjustments, though we will try to quickly discuss the accounting effects for all the adjustments. Again, at a lot of places, we prefer in the working notes to pass journal entries. Institute does not pass that. You don't even need to pass the journal entry. It is just to ensure that you give the double effects. As long as you are giving the effects in the working notes, it does not matter whether you pass the entry or not. So let us jump into the consolidation adjustments. First being the negative non-controlling interest. Can your non-controlling interest be negative? The answer is yes. In case the share of losses is so big that your non-controlling interest becomes negative, can it have a debit balance? The answer is yes. Nothing to be done because it is a part of equity now, and hence it can have a debit balance, no problem. Second is the fair value adjustments, which is one of the most important adjustments according to me. Why does this adjustment come? It is because when you see the question in front of you, you have the SFS of P and the SFS of S. Now, when Tata acquires a controlling stake in Jaguar and Land Rover, Tata acquires the controlling stake of JLR from a company which was the shareholder, let us say Ford. So Tata goes to Ford Motors, acquires 100% shares in JLR. In the books of JLR, nothing changes. JLR is still a separate legal entity, just that in the register of members, earlier you had the name of Ford, now you have the name of Tata Motors. And as a result, what happens? Well, JLR, for it, nothing changes. It will prepare its accounts. Usually, Ind AS 16 will apply, Ind AS 38 will apply, everything will apply as it is. However, for Tata Motors, when it prepares its consolidated financial statements, which is a separate set of statements, instead of showing investment in JLR, I will have to take over assets and liabilities of JLR. But these assets and liabilities of JLR, I will have to take it over at the fair value as on the date of acquisition. However, JLR is under no obligation to remeasure its assets at its fair value in its separate financial statements. So if JLR has a land which is worth 100 rupees, whose fair value is 500, Tata Motors pays an X amount SPC, acquires a controlling stake, JLR will still continue to show the land at 100 in its SFS unless it is changing its accounting method or following the revaluation model. It will continue to show it as 100. However, Ind AS 103 tells you that as the date of acquisition, Tata Motors has to take over all assets and liabilities of JLR at the fair value. And as a result, Tata Motors has to take over JLR's land at the fair value. This is 500. However, in the separate financial statements which is given to you in the question, it appears at 100. What do? Well, you kind of pass an adjusting entry. I mean, again, it is not mandatory to pass an entry. It is just for your convenience so that we remember the two effects are to be given. You don't just increase land. You have to give the second effect somewhere, otherwise the balance sheet does not tally. So you increase the land by 400. You pass the entry land account debit 400. The effect of that will come somewhere over here. When you are preparing assets and liabilities, your land will increase by 400. The second effect will go somewhere. Well, this land belongs to the owners, and the increase in the value of the land benefits the owners, so the credit has to go to the owners of the subsidiary. Who are the owners of the subsidiary? The controlling as well as the non-controlling shareholders. They are the owners of the subsidiary, and hence the profits for them are sitting inside the reserves. Which reserves? Well, you can call this as revaluation reserve, fair value reserve, or any reserve. You have to, whenever you are making an entry in the reserve, you have to ask yourself that are these reserves pre-acquisition or are these reserves post-acquisition? If these reserves are earned in the pre-acquisition period, then the pre-acquisition reserves means they are earned at or prior to the date of acquisition. Then you will do the adjustment in the pre-column. If the reserves are earned post-acquisition, then you do it post-column. Well, on the date of acquisition, JLR's land is worth 500. When JLR acquired it, probably a decade back, it was worth 100. So the appreciation of 400 happened at or prior to the date of acquisition, and hence the fair value adjustment at initial recognition is always pre. It will be adjusted in the pre-acquisition section, and as a result, you will see a plus 400 in the pre-section before the date of acquisition. That logically makes sense because you are telling the reader that the net worth of the company is only based on the reserves in the books. Yes, but the net worth is based on net assets, and you are taking over fair value of net assets. So net worth also has to be adjusted in order to get the fair value to be correct, and hence you will increase this, and your land will appear at 500. Your pre-acquisition reserves will be added in the pre-section, and hence your goodwill will also consider the fair value of net assets / net worth, considering the 400 appreciation, which is perfect. However, this is land. There can be building or machinery as well. After the date of acquisition, JLR will continue to depreciate the building at its carrying value. So let us say the building has a life of 10 years. JLR in the year after the acquisition will show the profits as 100 ka asset. 10 years is the useful life, then 10 rupees is the depreciation. So JLR would calculate its post-acquisition profits considering a depreciation of 10 rupees. However, Tata Motors is showing that asset at 500. Now it cannot just blindly consolidate the profit of JLR, which is calculated using 10 rupees depreciation. Tata Motors has an asset of 500, in which case it has to depreciate as 500 divided by 10, that is 50. But JLR is depreciated it only by 10, and hence you will have to put an adjustment for the additional 40. Now this 40 is arising during the year after the acquisition, and hence this 40 is additional depreciation to be adjusted against the post-acquisition profits. What is the journal entry? Well, your depreciation goes in the P&L, by the way, the post P&L to the asset. So over here against this, you will probably adjust 40 from whatever profits that JLR has. And then the second effect, so you are debiting the profit and loss, and the second effect will be against the PPE. So what would have happened is, subsidiary would have shown in its books 100 minus 10, it would have shown the land or building as the case may be at 90, and you will do these adjustments. So 90 plus 400, that is 490 minus 40, and hence this will come to 450, which is perfect. Fair value of the land 500 minus 50 ka depreciation, and you get 450, which is perfect. And accordingly the second effects are also considered. Now this is for the fair value of the land and building. This is called as the PPE adjustment. Now you can also have inventory, for example. So when we are looking at an inventory or something like payables, when you look at an inventory over here, you might have an inventory which is worth 100 rupees in the books of JLR. At the date of acquisition, the fair value of those cars, let us say, is 120 rupees. Now, Tata Motors will take them over at 120 rupees, though JLR will continue to show them at 100 rupees only. So, the initial fair value adjustment still applies. You will pass the entry inventory account debit, let us say 20, and you will credit the pre-acquisition reserves. Ideally, you will go to revaluation, but to be honest, a revaluation fair value does not matter because they are going to pre-profits, and pre-profits are going to go into the goodwill calculation. They are not going to appear in the final balance sheet. So inventory account debit, so increase the inventory by 20 and credit goes to the pre-acquisition profits. Now what happens subsequently? Well, the inventory does not get depreciated, but inventory can potentially get sold. So if the inventory remains unsold, then no further adjustment is required because the inventory in your closing books that is still there, it should appear at 120, it is appearing at 120. However, if the inventory gets sold, then the inventory has to be removed. You have already done a 20 plus and shown the inventory at 120, now it is sold. It must be removed, yes, but when it must be removed, you must have done a working like this. In your trading and profit and loss account of JLR, you must have, let us say, opening stock worth 100. Let us hypothetically assume there were no purchases and there must be a sales. Let us say the sales were made at 150 and there would be no closing stock as well. So the inventory is removed and your profit is calculated as 50. So you are consolidating 50 worth of profit because JLR says I want 50 of profit, which is right because JLR believes its cost is 100 for the inventory, but Tata Motors has acquired the inventory or the business considering the fair value, that is 120. So ideally your opening stock should be 120 in the consolidated financial statements. JLR individual does not have to remeasure, but in the consolidated it has to be 120, and hence 120 and 150 ka difference if you take, that is equal to 30, and hence your post acquisition profits have to reduce by 20 because your COGS was calculated as 100 in the SFS. It should be 120 in the CFS because your inventory opening stock is actually 120, and hence you will compare that with sales. When you compare that with sales, you will see that there is a profit of, let us say, 30 rupees, which should be shown. You have shown a profit of 50, and hence you will subtract post acquisition 20 ka adjustment. The second effect goes against inventory. So over here, post acquisition, that is P&L account debit to inventory. You have to remember a thumb rule if these concepts don't go as clearly in your mind, that whenever there is a fair value change prior to the date of acquisition or at the date of acquisition, it goes under against the pre-profits. Whenever there is a change later due to either depreciation or due to sale, it will go in the post-acquisition profits. The last adjustment over here is a payables adjustment. Something like, let us say, an ongoing lawsuit. The subsidiary, let us say someone like JLR, had a lawsuit with a third party, not with Tata Motors, which was ongoing. JLR believed that it does not have to pay anything, and as a result, JLR had just given a disclosure in its SFS. It continues to give a disclosure in its SFS. However, when you study business combination, you have been taught that you will take over assets and liabilities at fair value. So even if it is probable or not probable, at the time of acquisition, Ind AS 103 says Tata Motors will take over the payables at fair value, and the fair value over here probably is, let us say, 20 rupees. So when you take over assets and liabilities, liability in the SFS of JLR is 0, but Tata Motors says it is 20, and hence you will adjust it. We will say that, okay, your entry will be, this is a liability which was already existence as on the date of acquisition, so you will credit the liability, debit the pre-acquisition reserves. So pre-P&L account debit to payable. 1 year later, if this liability actually is paid, then JLR in its individual books will pass the entry P&L account debit to bank, because JLR did not record a liability, it had just given a disclosure. So it had shown, it will have to show a loss post acquisition. However, in the Tata Motors balance sheet, I already had a liability, and the 20 payment is not a payment of an expense but a discharge of a liability. So Tata Motors will pass the entry liability account debit to bank, but JLR has passed the entry P&L account debit to bank. We are saying that's not our loss. We thought that it was an acquisition date liability, and hence you will debit the payable, credit the post P&L, because in the SFS of JLR they would have shown an expense. In CFS it is not an expense. It's difficult to explain and cram this up in such a short time, but I'm trying to do my best so that you can get kind of a perspective over here. Okay, this is I mean, if you find it difficult to understand, just remember the changes at the date of acquisition are against the pre-profits, after the date of acquisition are against post-profits. If there's no depreciation given, no problem. If the inventory remains unsold, then no further adjustment. If payable remains unpaid, no further adjustment. The problem will arise only if there's a subsequent depreciation, a subsequent sale, or a subsequent payment for the payable. If that arises, whatever you do is going to be adjusted against the post-acquisition profits, is the thumb rule. Next, we have goodwill impairment. A part of this you might have even studied in IND AS 36, where you have to do slightly more adjustments. But if goodwill is impaired, then what should be the adjustment? We will say that why is there a separate adjustment for this? Well, because all other assets are 100% consolidated, but goodwill may be partial, may be full. If the goodwill is partial and there is an impairment, goodwill only to the extent of parent is recognized, and as a result, if there's an impairment, the impairment has to be borne by the parent only. The loss will be adjusted against the consolidated retained earnings to goodwill. So your goodwill will reduce due to the impairment, as we can see over here. And the second effect over here, as you can see, goodwill will reduce in the impairment in working note 2, and the second effect will go against only the consolidated other equity, the reserves. You will say less goodwill impairment over here in the other equity consolidated only to the parent share, because NCI does not have any share. However, if you are following a full goodwill question, then the goodwill is attributable both to the parent and NCI, in which case what the ICAI always does is, whatever is the impairment on the goodwill, they say that it is attributable to parent and NCI. Well, in what ratio? Well, let's say in the 70-30 ratio, in which case they will attribute the impairment also in that same ratio of 70:30. Achha. Now, that is about goodwill impairment, partial and full goodwill questions. Typically in these questions, goodwill impairment amount is directly given, and hence you can directly give the effect. You don't have to go up and do all the principles of Ind AS 36 that you earlier would have studied, because an impairment amount would be computed and typically directly given to you for this adjustment for goodwill. Unrealized profits on intercompany transactions, this is fairly important, especially if it is upstream or downstream transaction. Over here, it might happen that parent is selling goods to the subsidiary. Let's say 100 goods is the cost to the parent, it is selling it to the subsidiary at 120, and hence there is a 20 rupee profit which is recorded in the books of the parent. And there is an inventory which is recorded at 120 rupees in the books of the subsidiary. If this inventory is sold, no problem, but if this inventory remains unsold, then in my consolidated balance sheet I see an inventory for the group at 120, and then I see a standalone profit in the books of the parent at 20. Well, out of that, 120 is an overstatement of inventory because the cost to the group is only 100. So you will credit the inventory by 20, that is the unrealized profit full. Debit what? Well, we will debit the parent's profit and loss, which is in working note number 1, because 20 is sitting inside the parent's profit and loss. Subsidiary's profit and loss will not be impacted because subsidiary ka purchases be 120, a closing stock be 120, it will not impact the profits. On the other hand, this was downstream. On the other hand, it was upstream, that is subsidiary selling to the parent. Then the profit of 20 sitting inside the books of the subsidiary, 120 sitting inside the books of the parent. You will again remove the inventory, let us say by 20, but the second effect will go to the subsidiary's profit and loss account. And subsidiary's profit and loss, remember, belongs to both the parent and NCI. Will NCI also have to get a share? Yes, because NCI also gets a share in the profit. So if that profit is unrealized, NCI will also have to bear a share in that unrealized profit. So it will be adjusted against your subsidiary's profits, which is typically in working note number 4. Somewhere over here, probably you will have an adjustment which is upstream unrealized, something over here you will probably reduce. Now, when we are looking at upstream transaction, we need to figure out whether it should go from the post profits or pre profits. Typically that depends on the date when the upstream sale was made. If no such date is given, we will assume that it is from the sale made in the post acquisition period. Two special adjustments can come over here. One is if there's upstream or downstream sale of PPE, like this upstream or downstream sale of inventory, the adjustments remain the same. You still need to eliminate the unrealized profit. You still need to adjust the asset, but at the same time, because it is PP, there could have been depreciation. So if I have sold a PP of 100 at 120 and the acquirer has recorded the depreciation based on 120, 10-year useful life, the depreciation is 12, ideally it should be 10, then additionally a reversal of 2 rupees will also have to be done for the additional depreciation. In whichever company's books the depreciation is booked, you will adjust the additional depreciation against the asset. And the second special case is, will this elimination also happen if there are unrealized losses? The answer is yes. As long as the NRV of the inventory is greater than cost, you will eliminate both the unrealized profits as well as the unrealized losses. Achha. Then, so these are the crucial adjustments, I would say. Adjustment number 2, adjustment number 4 was crucial. 2 is fair value, 4 is upstream or downstream sale. Adjustment 5, not very important, uniform accounting policies. Remember, parent and subsidiary have to prepare their CFS based on a uniform policy. If the policy is different for like to like similar transactions, then the subsidiary's financials will be restated in line with the parent's policies. However, if there are different transactions for which you are following different policies, no restatement is required. Like parent has a inventory which is petroleum, for which they have followed weighted average. Subsidiary has inventory which is retail products, for which they have followed FIFO, absolutely fine, you don't need to restate. But if parent also has petroleum, subsidiary also has petroleum inventory, if they have different policies, well, subsidiary's financials will be restated as per the parent's policy. The adjustment, if any, will be done against retained earnings, and then will you go ahead and do the consolidation. That is about uniform accounting policies. Not a very important adjustment. Restatement, remember, is compulsory for different accounting policies, not for different accounting estimates, which can continue. If you want, you can restate for estimates, but not mandatory. When we look at different reporting dates, over here, if the reporting gap is more than 3 months, then you will have to redraft the entire subsidiary's financial statements. However, if the gap is 3 or less than 3 months, then you can make only material adjustments. What is material will be decided by the management, and find a restated balance sheet and consolidate based on the same date. The gap over here is 3 months. Then there are certain intercompany items like debtors, creditors, you eliminate. Bills receivable, bills payable, eliminate. Loans given, loans taken, eliminate. Like you might probably have certain interest adjustments also over here, and there might be investment in debentures or investment in preference shares. Typically these are financial assets in the books of the investor and financial liabilities in the books of the issuer. Typically, if that is the case, even if it is preference share, it is a liability, will not go in the goodwill working, it will go in the asset and liability. Debenture will also go in the asset and liability. The only additional layer of complexity that can come typically over here is, it is possible that since these are tradable instruments, a parent might have purchased 100 debentures or preference shares of the subsidiary by paying 120 rupees. Now there might be 200 such preference shares or debentures in the books of the subsidiary. I have acquired only 100, but instead of paying 100 rupees, I've paid 120. So when I eliminate, I will eliminate the entire 120 of investment, but samne only 100 of liability will be eliminated. The remaining 20 will be the loss, because we have implicitly paid 20 more, which will be taken against working note number 1, consolidated P&L. This is kind of an implicit loss on settlement. Another very important, the third very important adjustment which I would rate is the dividend adjustment. Now over here the problem largely arises if the dividend is paid out of pre-acquisition profits. Remember, if dividend is paid out of pre-acquisition profits, what that might do is, over here, if as on date of acquisition you had 100 rupee profit, during the year you earned, let us say, 60 rupees and you paid 40 rupees out as dividend. If this dividend is given to be paid out of this 100 rupees, then when we do the pre and post working, what will happen is, we will say that, let us say 100 is pre, 60, let us say date of acquisition is the first day of the year is post, and 40 is reduced from the pre-acquisition profits, which means we will assume that the remaining profits is, let us say, over here 60 in the pre, 60 in the post section. Let us assume for simplicity there is a 100% stake that the parent has in the subsidiary, and hence we will say that if I want to find the goodwill, I will compare the PC that I have paid with the share in net worth as on the date of acquisition, which is compared with the equity share capital, and you will compare, let us say, the pre-profit and loss. When I compare the pre-profit and loss, I will take, let us say, only 60 that comes over here. But as a matter of fact, as on the date of acquisition, I did not have 60 worth of reserves. I had 100 worth of reserves. By the way, 40 of them have been subsequently distributed. And when they were distributed, the parent would have, when the subsidiary distributed it after the acquisition, the parent would have received it. And the parent would have probably taken it into the profit and loss account, because Ind AS 109 says dividend that is received goes into the profit and loss account. So in the parent's books, a profit of 40 is appearing, which is actually intercompany. It is from the subsidiary. And in the subsidiary's financials, the profits are appearing at 60 rupees only. As a matter of fact, as on the date of acquisition, the reserves were not 60, they were actually 100. By the way, 100 may say 40 has been distributed, but to calculate goodwill, I need to find the net worth as on the acquisition date, not the net worth as on the consolidation date. And as a result, an adjustment is required. So what do? We say that in case dividend is paid out of pre-acquisition profits, then in my standalone profit of the parent, there would be certain 40 rupees dividend which they must have received. Achha, agar 80% stake hota, to 40 rupees into 80%, 32 must have been received, then the entry will be for 32. But let us say 100% stake, the parent must have received, let us say, 40 rupees, shown it as income, that is income from the subsidiary, does not get adjusted subsequently, and hence you will debit the consolidated P&L by 40. I mean, consolidated P&L, basically this is standalone P&L of the parent. Standalone of the parent you debit. Credit we will give to the net worth as on the acquisition date, or the goodwill workings as the case may be, you will give to the extent of 40. What is the reason? Because in the goodwill working you have taken only 60. Ideally your net worth as on the date should be 60 plus 40. So you will say that, okay, there was certain share capital as on the date of acquisition, certain reserves which still remain undistributed, but there were certain reserves which were subsequently distributed, but they existed as on the date of acquisition. So you will credit the goodwill workings, debit the standalone profits. and that's it. The logic for this is so that you can calculate the goodwill correctly by taking the share in the net worth correctly, and you can find the profits attributable to the group correctly. So then we should also do it in the post profits. Well, you can if you want to, but it automatically self corrects, because if this dividend was paid out of the post profits, then if this 40 is shifted on the other side, then 60 minus 40 equals to 20. Your goodwill remains correct because you have taken 100 only in the goodwill working. Now there is no 100 minus 40. 100 was the net worth as on the date of acquisition. We have correctly taken 100, so goodwill working is not wrong. Sir, but the P&L working is wrong because you have shown 40 rupees as income which the parent has earned from the subsidiary, but against that income, remember, you will now not consolidate 60, you will only consolidate 20. So there is an income which is an overstatement by 40, but then you are taking 40 rupees less of the subsidiary. So in a way that 40 and 40 gets nullified, your answers do not alter. So long story short, if there's a pre-acquisition dividend which is paid out of the pre-acquisition profits, remember the date when the dividend is paid is not relevant, the source from which it is paid is relevant. Sir, how do we come to know? Well, generally if nothing is given, we can assume that the dividend is paid out of the post-acquisition profits, the profits of the year for which the dividend is paid. However, if it is specifically given that dividend is paid out of opening balances, dividend is paid out of the pre-acquisition amount, then you adjust it accordingly. Achha. So if dividend is paid out of pre-acquisition profits, you will have to give an adjusting effect in working note number 1, where you reduce the pre-acquisition dividend which is already a part of the standalone parent, and you increase the net worth in working note number 2, so that you can calculate the correct amount of goodwill. You can show the adjustment in a manner which you like. We typically like passing an entry and then accordingly giving the effects. If it is out of post-acquisition profits, in my opinion, the answers will remain the same. Institute also does not give an additional effect because they automatically self-correct. Acha. So we have given the rationale over here. Bonus, to be honest, is not very important. It is not even there in the study material. However, in the old course, you had a couple of adjustments for bonus. So there are various things, but it is not as important as dividend is. So in case of bonus, bonus is also an appropriation. It is not really an expense, it is a book entry. So if there's a bonus, let's say you were subsidiary at 100 shares, you are holding, let us say 60 shares, and the company gives a 1:1 bonus. In the subsidiary's balance sheet, you will see 200 ka share capital. But in the adjustments, you must be given that on a particular date, we acquired 60 shares. Arre barabar hai, but after that, we also received a bonus. And bonus is nothing but reserves account debit to share capital. It is just transfer of money from one shareholder pocket, that is reserves, to another shareholder pocket, that is capital. So you pass the entry reserves account debit, let us say, to share capital, in which case, it's just a book entry. However, in order to calculate the stake accurately, you will have to take in the numerator number of shares pre-acquisition, that is 60, divided by the number of shares pre-acquisition, not 200 but 100, that is 60%, or you take the number of shares post-acquisition, that is 60 plus 60 bonus, that is 120, with the number of shares in the subsidiary post-bonus, that is 100 plus 100, that is equal to 200, you will still get a 60% stake. That is the first thing you need to be careful in the stake calculation. Second, the source from which bonus is paid. Well, if nothing is given, we assume that the bonus is paid out of pre-acquisition profits. The oldest profits get capitalized first. For bonus, again, you can pass adjusting entries. That is, if the bonus is paid out of post-acquisition profits, you can adjust the post-acquisition profits and give the second effect against the goodwill working, because share capital has gone in the goodwill working. Or on a simplistic basis, if you don't want to do that, you just reverse the entry for bonus. You nullify the effect of bonus, because bonus, to be honest, is a nullity in the books of subsidiary. If there's a bonus, it is just a book entry. So if you reverse the effect of bonus, you say forget the fact that bonus was happened. In which case, you find the share capital before bonus, you find the reserves before bonus, and do the working in the usual manner. Your answers will tie up, just in case, rarest of the rare case, if bonus were to land out. Then there are a couple of adjustments for which a full-fledged question does not come, but maybe smaller adjustments can come. That is, if you were to take an additional stake, or if there was a stake sale. We first study additional stake. Additional stake which may give you control, or additional stake which does not give you controls. Like, for example, you were owning a 20% stake and you acquire the remaining 80%, in which case that 80% gives you control, in which case Ind AS 103 will apply, which tells you that the existing investment will be revalued at fair value, and then you will take over all assets, all liabilities, create goodwill. You would have done that in business combination in various big sums. Second, if there is an additional stake which does not give you control, or it is after control is acquired, like you already have an 80% stake and then you acquire another 20% stake, then what will be the effect? Well, this is a transaction. How will you treat it? Will you treat it as purchase of investment? The answer is no, because in my CFS, I show all the assets and liabilities. I don't show the investment in subsidiaries, so it is not a purchase of investment. Should I show it as a purchase of net assets? The answer is again no, because I've already consolidated 100% of the net assets, even when I had an 80% stake. Then how do I show this? Well, this is shown as a purchase of NCI. Because earlier there was a 20% NCI, which is now no longer there, and hence you show it as a purchase of NCI, in which case what do we do? Well, NCI over here will be debited to bank. Whatever you are paying will be credited in the CFS. Where will the balancing figure go? The balancing figure has to go to other equity. Remember, don't take it to the statement of profit and loss account. Don't take it to goodwill. Students will say we take it to goodwill because you are acquiring a 20% additional stake. No. Ind AS 103 says goodwill can only be created as on the acquisition date, which is the date when control is acquired. This 20% does not give you control, and hence no further goodwill can be created. Second, you can't take it to the P&L because it's an owner to owner transaction. NCI is also an owner. You are also an owner. So it is like retirement of a partner. And if the partner retires, and if you are paying more or less, the gain or loss does not go to the profit and loss of the partnership firm. It adjusts against the capital balances of the partner. And as a result, we adjust it directly against retained earnings. There will be no impact on the goodwill or the statement of profit and loss account. So this is your entry. Next, you have stake sale. Stake sale again can have two possibilities: stake sale resulting in a loss of control or not resulting in a loss of control. So if stake sale does not result in a loss of control, like you had 100% stake and you have to give up 20% stake, then what is this transaction? It is a creation of NCI. It is not a sale of net assets transaction, because you still continue to show the net assets at 100%. It is not a creation of investment transaction, because you don't show investment still, but you show an NCI. So it's a creation of NCI transaction. It's like an admission of partner. The entry over here will be bank account debit to NCI, and the balancing figure will again go to the other equity by the same logic. Here you need to be very careful that while you're creating NCI, you will create NCI by including net assets as well as goodwill as on the date when the stake sale happens. A lot of students over here believe that if NCI is created using proportionate net assets or partial goodwill method, we will not add a share of goodwill. Typically yes, but in this case you will have to add, because if I had a 90% stake and now when I took the 90% stake, I would have recorded goodwill for my share, that is 90%. When I sell 20% and come to 70%, I do not derecognize goodwill to the extent of 20%. Goodwill continues to appear in my books at 90% only, and hence the new NCI that gets created will get a 20% share in that goodwill, and hence that goodwill over here will continue to appear at 90%, but 20% of that is attributable to NCI, and hence the new NCI that gets created will have a share in goodwill. The existing NCI may not have a share in goodwill. Remember that. Next, we have a stake sale which results in a loss of control. In case the stake sale results in loss of control, this is where assets and liabilities of the subsidiary go out. Till a day before the stake sale, all assets, all liabilities of the subsidiary were there. Now, once the stake sale happens, all asset, all liability will be removed. Acha, is that it? Well, will NCI also be removed? Yes, whatever was the balance of the NCI will also be removed. Is that it? Well, money will be received, so bank will be debited. Your entry will be bank account debit, NCI account debit, to net assets of the subsidiary, to goodwill of the subsidiary as well, which will also be removed. Can there be a balancing figure? Well, yes, that can be shown as a gain on sale. Can that go to other equity or P&L? Well, we can take it to the P&L account, because this transaction is treated as a disposal of net assets transaction, in which case a gain or loss can go to the profit and loss. However, we are discussing about this considering the stake sale results in a loss of control and you have no investment left. However, it is possible that you had an 80% stake and you sell your let's say 60%, in which case you are still left with 20%. In which case you will still eliminate 100% of the assets, still eliminate all of the NCI, still eliminate all of the goodwill, but at the same time you will now have to introduce or bring in investment in your books, which was not earlier there. Sir, investment was there in SFS. Remember, SFS is different, CFS is different. You will have to bring in the investment. At what value will you bring in? Well, fair value, if that is available. But if fair value is not available, we can say that just a day before the subsidiary was appearing in our books, 1000 k net assets, 200 k NCI. So the carrying value of the subsidiary was probably 800. That 800 was for an 80% stake. Now 20% is still remaining. So how much would be the proportionate value? Like, this is exactly like NCI working. Like a day before, these were appearing in my books, which I had an 80% stake. They were appearing in the form of line by line assets and liabilities. Here, instead of line by line assets and liabilities, they are now appearing as an investment, but investment can be shown either at fair value or it can be shown using the proportionate net assets value. Like when you create NCI, you can create NCI at fair value or the proportionate net assets value. The gain or loss after recording investment can be shown as gain or loss on the sale of stake, and if you're showing the investment at fair value, then the gain or loss on remeasurement as well. So you can do some practice over here. The next thing which is extremely important, I would say, is chain holding. Now, what do you mean by chain holding and what do you mean by parallel stake? Parallel stake is the case where there is P. P has multiple subsidiaries, S1, S2, S3, S4 as a case maybe, but all of these are held by P. In which case, it is the same sum that we do, just that there are multiple subsidiaries. You can do it in a columnar format. However, if there's a chain of holding, like P has a stake in S has a stake in another company, let us say S2, S1 has in S2, then how will consolidation happen? Well, if P has an 80% stake in S1, S1 will be consolidated with P, but will S2 also be consolidated with P? Well, it depends on whether control is there. Control comes from the ability to direct relevant activities, which comes from voting power, not with effective stake. So with an 80% stake, I can order S1 to vote for the entire 60% in a manner that P desires, and hence P controls to control S2, continues to control S2, and hence both S1 and S2 will be controlled by P and hence consolidated with P. Students over here can potentially think and say 80% into 60% comes to 48%. P has only 48% share in S2. Absolutely right. Not 48% share in the voting power though. It is 48% share of the net assets. Because if S2 has a net assets of 100 which it wants to distribute as dividend, it will distribute 100 out of which 60 will reach S1. If S1 distributes it, 80% of that, that is 48 will reach P. So out of the net assets of 100, 48 reaches P. The remaining 52 goes to whom? Well, to the non-controlling interest holders. And hence NCI in S2 will be measured not just at 40% but at 52, because parent gets only 48 of the assets, which means 100 minus 48, that is 52, is attributable to NCI. But sir, still there is control? Yes, because if there is a land of the subsidiary 2 which has to be sold, parent by virtue of its 80% stake can order S2 or S1 to vote in a manner it desires, and hence the control still remains. Step 1, you will try to assess control in case of chain holding. Step 2, you will try to find the NCI, and NCI over here is calculated as 100% minus the parent's effective stake. Do not just take 40% as the NCI for S2. It will be 40% direct plus the 20% that NCI is there in S1. They will also get a share in S2's assets, and hence there is some indirect NCI as well. 52 is the total NCI. You will also have to be very careful of the date of acquisition. Date of acquisition is the date when the parent actually gets control over S2, which is typically, the date when parent has control over S1 and S1 also has control over S2. That is the date that you have to look at. Now, this is also easy from my understanding. The only problem that arises are twofold over here. First is the NCI calculation, and then incorporating this in the consolidation process. Your consolidation process continues to remain the same. You prepare the Schedule 3 balance sheet. You prepare the notes comprising of assets and liabilities, where you take P, S1, S2, also take the adjustments and then the total. You show the equity share capital, but before you prepare the working notes 1, 2 and 3, you will try to show an NCI working, where you will say 100% minus 52% will be 48% NCI of S2. That is the first additional step. And second is, you need to eliminate investments. Till now what had always happened is, you had seen investments in subsidiary in the books of P. All assets in the books of P are attributable to the parent shareholders only. Now investment will also appear in the books of S1. Remember, this is investment in S1 will appear in the books of P, and then there is an investment in S2 which will appear in the books of S1. Remember, all assets and all liabilities of S1 are not just attributable to the parent. Assets and liabilities of S1 are attributable both to the parent as well as the non-controlling interest of S1. यहाँ पे बच्चे confuse हो जाते हैं. First of all, what they do is, they take the entire, let us say this is 1000 rupees. So they will say this entire 1000 will go in working note 2. You will eliminate it to calculate goodwill. The answer is wrong, because 1000, when you take in the goodwill working, you are saying this 1000 is invested directly by the parent. Answer is wrong. You are eliminating the investment in the books of S1. Every asset in the books of S1 is attributable to parent as well as NCI of S1, not just parent. And hence, only 80% of this 1000, that is 800, will go in working note 2, which is the goodwill workings. Then where will the remaining go? Where it will go in working note number 3, which is the NCI. So the remaining 20%, that is 200, will be eliminated accordingly. So when you eliminate the investment in the books of S1, your effective entry will be over here. You will have, let us say, your goodwill workings account debit. You will have NCI account debit. Why goodwill workings? Because this is an investment, so it will go against goodwill working, and then you will eliminate investment. Remember, this is investment in the books of S1. Every asset, not just investment. If PP has to be impaired in the books of S1, the PP is attributable to parent and NCI both, and hence वो भी 80-20 का ratio में जाएगा. Goodwill is impaired. If it is partial goodwill, then only parent. Full goodwill, वो भी 80-20 का ratio में जाएगा. So over here, this is investment in the books of S1, and hence 800 and 200. Where will the 200 go? 200 will be reduced at the end in the NCI working. A lot of students wonder, why should it be reduced? Well, because NCI is debited. Investment is credited, NCI has to be debited, and hence your ultimate NCI, whatever you get, has to be lower to the extent of this investment attributable to NCI. So this is something that you need to be slightly more careful about. Achha, there is also one more adjustment that we want to discuss, which we have kind of covered directly. So these are 5 adjustments which I would say is very important. First is fair value adjustment, second is upstream downstream inventory adjustment, third is dividend adjustment, fourth is chain holding, and fifth is NCI appearing at fair value. So your workings when NCI appears at fair value remains the same. However, your calculations can potentially change because you can't do it in the usual manner. Why? Because we were saying that, okay, if the share capital is 70%, 70% of the capital is attributable to the parent, 30% is attributable to the NCI, pre-profit 70 to the parent, 30% to the NCI, and accordingly you are finding the NCI. Now, irrespective of what the share of NCI is in the share capital or in the pre-acquisition reserves, NCI at the acquisition date has to be shown at fair value. So if NCI at the acquisition date has to be shown at the fair value, your goodwill has to take that into consideration. So you will take the PC 70%, that is investment in the usual way, plus, sorry, this is not minus, this is plus NCI at the fair value on the acquisition date, like you do in business combination. You will take, okay, 30%, forget how much is the equity share capital attributable to NCI, how much is the pre-acquisition reserves attributable to NCI, as on the date of acquisition, what is the fair value of the NCI? You take that directly, fair value. That will be the opening balance of NCI as well. So when you prepare the NCI working note, the opening balance will be the fair value. Now, since I am no longer comparing just 70%, I am now comparing 70 plus 30, that is 100%, in which case I will compare this with 100% of the net assets or 100% of the net worth. So, equity share capital earlier used to do 70% to the parent, 30% to NCI, pre-profit 70% to parent, 30% to NCI. Now, the NCI as on the acquisition date is taken in working note 2 itself, and hence the share capital attributable to NCI will also come here. The reserves pre-acquisition attributable to NCI will also come here, and hence we will take the pre-P&L, pre-other reserves, pre-dividend, everything 100% will come over here, and that will give you the full goodwill. Remember, NCI starts at fair value, but every balance sheet date you don't remeasure it at fair value. Post-acquisition, whatever profits are earned, 30% of that will be attributable to NCI still. So this is the adjustment where there is a fair value for NCI. Apart from that, there is joint venture and associate, which probably we can keep for another session. And then there are certain exemptions available. This is more for theory while you prepare full consolidation. Yes, there is also foreign subsidiary adjustment, which is very rare, but if it comes, it is along with IND AS 21, where you have to translate the subsidiary's financials into the parent's currency using the closing rate for assets and liabilities, historic rate for share capital, historic rate, acquisition rate for reserves, pre-acquisition, and average rate for reserves post-acquisition. If there is any foreign currency translation reserve, that is always post because it arises after the acquisition date, attributable both to the parent and NCI. Goodwill has to be calculated in the foreign currency, and then it has to be restated at the closing rate as per specific instructions given under IND AS 21. You can refer the specific guidance under IND AS 21 for this. Now, there are certain exemptions just for theory for the purpose of consolidation, which can be available in case of a wholly owned subsidiary. These exemptions are available for intermediate companies. So there is P के नीचे S1, S1 के नीचे S2, S2 के नीचे S3. For S2 and S1, which are intermediate companies, there is an exemption available from preparing CFS. P, there is no exemption. If S1 and S2 are wholly owned subsidiaries, if P, which is the ultimate company, does not intend to prepare the consolidated statements, exemption is given as long as S1 and S2 are not listed. If these are partly owned subsidiaries, then S1 and S2 will write to the non-controlling shareholders, and if none of them raises any objection to the non-preparation, they may still skip the preparation of financial statements. All of this will apply if the ultimate company is preparing accounts as per IND AS, the consolidated financial statements. There's also an exemption pertaining to investment entities. So if your entity is an investment entity like a venture capital fund or a private equity fund, in which case you assess the performance based on fair value, and hence you can show these investments at FVTPL rather than following the full consolidation method. When is a particular entity an investment entity? Typically when it is core engaged in investment management services, its core objective is to earn capital appreciation or investment return, and it is evaluating investments on a fair value basis. Typically, these companies have an exit strategy in place. They have more than one investor. They have more than one investments. They don't have any other objective other than pure earning interest and capital appreciation like mutual funds. Okay, so I guess this largely takes care of our discussion on consolidation. I'm sorry I could not really solve a sum specifically, but I think maybe you have got some sense of the adjustments. Let me know if you have any other feedback or any other views. If you like the video, please do share and subscribe. All the very best for your exams. We'll just keep on sharing more revision videos to the best extent possible. Do let us know your views, your comments, your feedback, and wish you all the very best. Study hard, study well, be confident, be positive. This is, you are going to crack it for sure. Good luck, goodbye, take care. This is BHAVIK CHOKSHI signing off.